A lot of people keep asking the same question: when will interest rates finally come down? It's a fair question. And during the last Fed press conference, reporters asked it directly. The answer wasn't simple, but it was revealing. When asked about future rate cuts, the Fed chair didn't give a date. He said decisions will depend on incoming data. That phrase tells us how the Fed thinks. Two main things guide those decisions: jobs and inflation. If the job market weakens, that could be a reason to lower rates. If inflation cools, that could open the door. But if neither happens in a clear way, rates can stay right where they are. The chair explained that the job market looks stable for now. That removes pressure to act quickly. At the same time, inflation is still higher than their target, not exploding but not finished either. This creates a tight spot. When asked which risk worries them more right now, the chair said both risks have eased. That's important. It means they don't feel pushed in either direction. For people waiting to refinance a mortgage, this matters. For people hoping credit card rates fall, it matters. Waiting may not bring quick relief. This doesn't mean rates will never come down. It means the Fed doesn't see a reason to move yet. They want clearer proof that inflation is under control. Another question came up that deserves attention. A reporter asked about the growing gap between wealthy households and everyone else. The chair didn't deny it. He acknowledged that people with assets are doing better. Stocks and property have risen. At the same time, he acknowledged that lower-income households are struggling. Retailers see customers trading down, buying less, stretching dollars. That contrast is not hidden from the Fed. They see it clearly, but action can be slow. The Fed's tools are blunt. They affect the whole economy, not just one group. This is why high rates can feel unfair. They weigh heavier on those already stretched thin. Understanding this doesn't make it easier, but it does explain why relief hasn't arrived yet and why expectations need to stay realistic. In the next part, I'll talk about what you can do. Even when you understand why interest rates are high, that doesn't make day-to-day life easier. Bills still show up, payments still feel heavy. If you have credit card debt, the interest rate is usually the biggest problem. Not the balance itself, but how fast it grows. Those payments can feel like you're stuck. Some people are looking into balance transfer cards with temporary low or zero interest. It's not a solution for everyone, but it can slow the damage while you pay things down. For people with variable rate loans, stability matters. If refinancing to a fixed rate is possible, it may offer peace of mind. Sometimes predictability is just as important as savings. Renters often feel stuck, but waiting can sometimes be a strategy. With mortgage rates high, buying right now may not make sense. There's no shame in waiting for conditions to improve. If money feels especially tight, assistance programs exist for a reason. Energy help, food assistance, housing support. Using them doesn't mean failure, it means adapting. One part of the Fed discussion that shouldn't be ignored is government debt. The Fed chair described the current budget path as unsustainable. That pressure remains long-term. This is why it's important to plan as if rates stay elevated, avoiding new debt when possible, prioritizing high-interest balances, building even a small emergency buffer. It also helps to remember that interest rates move in cycles. They rise, they fall, they always have. This feels heavy because it follows years of very low rates. That contrast is sharp. The Fed's goal isn't to punish households, it's to prevent inflation from getting out of control again. That trade-off is uncomfortable, but understanding the goal helps explain the choices. Here's the calm reminder I want to leave you with. You're not failing because things feel harder. The system is tight right now. Many people are adjusting. Getting through this period is about patience, information, and small, steady decisions, not perfection. Knowing what's happening gives you control over how you respond. Awareness is key. One thing I don't want you to take away from this is fear. Yes, interest rates are high. Yes, life feels tighter, but understanding the moment matters more than reacting to it. A lot of frustration comes from not knowing why things changed. But this isn't about bad choices. It's about a system adjusting. Low rates didn't last forever. Now we're in the correction phase. That doesn't mean you should stop planning for the future. It just means the timeline may look different. Some goals get delayed. That's not failure. That's adapting to conditions you didn't create. If you're carrying debt, the focus right now is survival, not perfection. Reducing interest exposure where possible. Avoiding new balances. Those choices add up quietly over time. If you're saving, even in small amounts, that still counts. $50, $20, whatever fits. That cushion can prevent stress later. Progress doesn't have to be dramatic to be real. It's also okay to pause big decisions. Buying a home, taking on a new loan, waiting is a decision too, and sometimes it's the smartest one available. There's no prize for rushing. What matters most is staying informed without getting overwhelmed. Headlines can be loud, predictions change, but core signals move slowly. Watching them helps you make calmer choices. Here's the trust reminder I want to share. Nobody has a perfect roadmap right now. Not policymakers, not families. We're all responding to the same conditions one step at a time. Being steady matters. This channel exists to help you understand what's happening, not to scare you or sell you hope. No promises, no pressure, just clarity, context, and tools to think things through. That's it. If this explanation helped you see the bigger picture, take that with you. Use it to make choices that fit your life. And remember, hard periods don't last forever. Thanks for spending this time with me.